This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney, and today I am very pleased to welcome on Lauren Wells, co-founder of 7E and CWS Investments. Lauren, thank you very much for being on with us today. So, as with all of our guests, I always like to ask people to give us a little bit of background about yourself. When it comes to investing in the alternative space, rarely do people kind of just go the trajectory of, I went to college, I got a degree in X, and now I am an alternative asset space. So kind of give us a little bit of the trajectory of, who you are and how you got to be where you're at, and then we'll kind of dive into the topic of hand of mortgage notes.
Yeah, definitely. So thank you for having me on the podcast. Excited to be here today. A little bit about how I got here. I feel like it's a story most people have heard, maybe not from me, but from someone else. I went to university, studied political science, thought I was going to be an attorney, studied for the LSATs, realized I would probably love law school, but would not want to actually practice law. So I pivoted out of that. And at the time, tech in Silicon Valley and where I am in the Central Coast in Santa Barbara was booming. A lot of startups were hiring. So I kind of switched gears and went that startup life into sales and business development. Went through two companies through IPO, was with two companies through IPO. And about that time, my husband and I had just gotten married. We had done all the traveling we wanted to do, and we wanted to start a family. And as I thought about what that looked like and time-wise and, what my parents and how involved in everything that they were, that's something I wanted for my kids, to be there at their practices, their soccer games, those things, whatever they're into. And so I really started looking into what people who had time were doing, who were able to, you own their time. And it was typically they either owned some sort of business or they were investing in real estate. So I started with the first. I started consulting. I ran my own consulting agency. And then at that same time was starting to look into real estate. Your very standard buy and hold, because that was, a basic concept. Everyone understood that. Buy and hold, rental income. And it wasn't until a few years after that I started looking into mortgage notes because it was kind of a similar concept, very niche asset class, as we'll get to in a second. But it was something that people who didn't necessarily want to be a landlord were getting into. And it appealed to me from that sense. And I've learned a lot about what it was portrayed as and where I am now and what I realize it actually is. And so that's kind of what landed me today. Built my own portfolio up to about 50 mortgage notes before I partnered with my current business partner and launched our current fund.
Fantastic. It's always interesting to hear people that have a slightly similar trajectory to what I did. I was the investment side. I took the LSATs and then decided to you
got a step further than I did.
Yeah, did that. Unfortunately, we're, in Florida in 2011, 2012, the job market was, to say it was bad was putting it lightly. We were, crushed by the recession and just kind of fell into, I was like, all right, the first job I can get in finance happened to be in alternative investments. And well, 11, 12 years later, here I am. So It's always interesting to hear people that, we're going to go to law school and then did something different. And we're both in alternative investments. So, hey, I guess there's something to it. It's definitely interesting to hear. Most people kind of, again, have that trajectory, especially in real estate of, hey, like real estate's great. And it always kind of bums me out a little bit that it's called an alternative asset when, Romans were, buying real estate and conquering, parcels of land. It's like, how alternative can it be? The stock market's only, maybe 130 years old. This is not exactly an alternative. But the other side of things is that, real estate is many things, but cheap it is not. And the debt side of things is really, again, to your point, people that don't want to deal with tenants, termites, toilets. How do you get involved in real estate? Well, be the side of the money, where you can especially from the aspect of one, not have to deal with that, but two, especially for our clients and doing this with retirement plans, you get a big shield of liability protection when, without having to use a bunch of complicated structures, trusts, LLCs, weird stuff. There's an investor locally to us here and is nationally known as well, but to steal Pete's phrase is that when someone trips and falls down the stairs, they don't trip over the mortgage note, they trip over the floorboard that the landlord never bothered to replace. So, again, from the aspect of being able to shield yourself from, liability in the sense of, being involved in real estate mortgages and notes are a great aspect of that. So not to opine on, fun topics, but let's kind of jump into, kind of the thesis of, how you, went from investing in real estate to what really made you interested in debt. Was it the not wanting to be a landlord anymore, or what was kind of the attractiveness of that brought you into the debt side of the equation?
Market opportunity, really. I'm in California, and I'm one of those people who wants to invest where I live. So you can imagine that's not as easy to do from a, I'm going to buy a rental perspective. And then mentors that I have had in the real estate space that either were looking into mortgage notes, had looked into mortgage notes, were investing in mortgage notes. So it was kind of an echo of who I surrounded myself with, and also, barrier to entry. So, I started out specifically with seconds, performing and non-performing second liens, which allowed me to kind of get a feel for how it all worked, who were the players, where was I able to get these assets. And then, obviously with seconds, there is a little more inherent risk in that you're not in first position. But at the time, right before COVID, and then COVID really helped a ton, values were going up. So coverage wasn't really an issue. And it allowed me to get my feet wet for, as little as, I think that, one of the first seconds I bought was only like $2,000.
Nice.
So yeah, was there a huge payoff? No, but was I able to get used to the idea of what this looked like and the management that went into it? Yeah. So
yeah,
it appealed to me.
Taking a class, even if it's one that doesn't pay off, is much cheaper at $2,000 than some of the other courses that you can take in this stuff.
Yeah.
So that's kind of interesting. So you initially kind of, broached the topic of doing this personally with acquiring existing notes. You weren't necessarily going right into originating new or lending new on second. So you really kind of, and that's interesting, I think. So was that, again, a product of the people that were around you and mentoring you, or was it something that just say, hey, price point be what it may, and it's a little bit easier to go buy something that's already there? Again, why'd you kind of get into buying existings? I think I understand why you did seconds, but why were you buying existings instead of trying to originate new?
Yeah, honestly, just area of interest, and again, kind of who I was surrounding myself with. The private money lending is kind of what I would say originating notes falls into. That's something that I did eventually start to do once I became more familiar with how everything worked behind from a legal standpoint, and so starting out, it was just more, I want to get into this industry. I want to see what it's like to manage a note, the legalities behind it, what states are of interest to me, because every state is completely different in terms of, foreclosure rules, legal rules, recordings, the mortgage and everything is so different. So I think it was just, again, kind of a lower risk to buy something that was already originated at a discount and kind of work it out.
Yeah, and especially, you have to, it's what I tell a lot of clients, and I have plenty of people that come to me kind of a little bit, fresher in the space saying, hey, I want to lend someone money, because it's a little bit easier to wrap your mind around, I think, a few different aspects of lending. But, you have 50 different flavors of usury, of different ways that things are recorded. Is this a judicial foreclosure state? All sorts of different things kind of factor into that people, don't realize, yes, a promissory note can be a simple one-page thing where someone's saying, hey, I agree to repay you. And you could, certainly buy that secondarily or go the origination route. But you're right, there's a lot of stuff to learn in buying something existing. Granted, you're going on the faith that it was originated properly, and you're not buying something that, don't like to use the word toxic, but the toxic asset, kind of, I guess, is the best word to use for it. So yeah, definitely, getting in, and also the price points being what they've made. So let's kind of start from there. So you bought a couple, you got in, you were doing seconds, risk versus reward, definitely a little bit of a riskier position, hoping that they pay the first, because if they're not paying the first, they're not paying the second. So, where did you kind of go from there? You saw the benefit of it. You're here now. You're in the debt side of things. So where does your kind of investing career take you from there?
Yeah, I kind of transitioned from seconds into firsts. Obviously, you have more skin in the game. I had more experience, and there was bigger potential for upside. After getting familiar with seconds, going into first, and then meeting my current business partner, I helped then manage his funds when he had over 200 assets at the time. So I got used to really seeing every example or scenario that could possibly pop up from state to state, from, a $50,000 loan to a $300,000 loan, very different line sizes. And so it was really good experience. Like, I had built up my own, I managed those, and that was easy for me because it was just mine. They were pretty siloed to a few states. And then kind of the next step was really doing this on a larger scale and expanding my knowledge base around the ins and outs of notes in general, but also, what different exit strategies there are. So when I was doing this on my own prior to meeting Chris, it was really, okay, you send the demand letter and you go through foreclosure, or the borrower comes to some sort of resolution with you. But that would typically be either a payoff or you'd put them on a payment plan. Come to find when, I started helping Chris manage his portfolio, and Chris being Chris and very creative, there are just so many different options you can take to work with a borrower that I hadn't really been utilizing when I was only managing my own portfolio, that are more of a win-win for you and the borrower. And it just gives you more flexibility when you're looking at acquiring a note. If you can kind of, have a pro forma, so to speak, or a model that shows you, okay, if we take this exit strategy or this extra strategy, these will be our different returns. It really was good to kind of get my experience in that, and then, helped manage those funds, and then started to go into, partnering together in this latest offering.
Gotcha. So before we really dig too far in deep again to the kind of investment trajectories and how you kind of put things together at 70 Investments and CWS, when you kind of made that transition from first to seconds, were you only dealing with non-owner occupied properties? Were you dealing with owner occupied, strictly investment stuff? What was kind of the avenues that you were following when you were doing your personal stuff?
Yeah, owner occupied, definitely owner occupied. I was looking specifically in the Southeast, would be where most of my properties or notes were. I had one in Alabama. I learned a lot there about redemption time frame. And, I went through a bankruptcy with one. So really what I found is I really liked owner occupied single family homes in like the mid range of value. So I'm not looking at your, $3 million home. I'm not looking at your $50,000 home in terms of value. I'm looking at something that's like maybe between 250, 300, and 500.
Okay, cool. And that's interesting. I always like to ask that question when I talk to the debt people, because you really have two different camps. You have people that say, I don't touch owner-occupied, Dodd-Frank is, a 900-page document, which I've had the distinct pleasure of reading, which is, will put, anyone to sleep. But, it's one of those things where I always like to kind of gauge, when I talk to the debt people of, which camp they're in, because rarely do they kind of cross-pollinate with their investment strategies. They're either sticking to one or the other, and there's benefits to both. When it comes to, especially, and I think this will probably play into, again, transitioning into what you're doing professionally now, the ability, or I should say, the desire for someone to want to bring a note current on something that they're currently living in is significantly greater than someone that's like, oh, my rental portfolio, okay, well, if I let 3 of these go, fine, I can always make that money back. So
yeah. So honestly, that's a big part of it too. It's the vested interest in the borrower wanting to become reperforming, especially in today's market when rental rates are skyrocketing and their mortgage is probably half of what it would cost them to rent something of, equal, 3-bedroom, 2-bath or whatever it is.
Oh yeah.
And then also on the flip side, like you mentioned, if it's part of someone's rental portfolio, typically it's a legal nightmare because, they're like, I'm going to throw this, I'm going to file for bankruptcy, I'm going to do this. And it ends up just becoming not fun.
Yeah.
So definitely did learn my lesson there, and really started only looking at owner occupied.
Yeah, but just from my experience with people, I've seen some crazy discounts that people get on the underperforming side for the portfolio loans that people are doing. So, there's, especially now, I had a guy that was buying up, it was like 4 or 5 different non-performing notes from 2 different people. I think they had been commingled. They had known each other, let's just say, and the kind of discounts that guy was getting on what he was buying from them was absolutely just mind-blowing to me. I'm like, pennies on the dollar. I'm like, you're almost getting for fractions of pennies on the dollar for this stuff. I'm like, good on you. But yeah, again, not to get too far into the weeds of interesting stuff I've seen. You've gone through kind of your your educational cycle, if you will, on your personal side of going from seconds to first, mainly only focusing on the owner occupied stuff, and then you get linked up with your current partner, and then helped to co-found 70 Investments. So, give us a little bit of background on kind of what again, you said you started helping him manage some of his portfolio. So what was, again, kind of the catalyst for saying, okay, we have something here, let's, form an investment firm to kind of go after this? And what exactly is kind of, again, the thesis of what you're doing now currently?
Yeah, so Chris had, at that time, I think about 3 offerings that were in process. At this point, he's had 5 funds go full cycle. Now, what we did was pretty unique. When he first started out, he was doing a lot of joint ventures. The typical, you have your own portfolio, you go the joint venture route, and then you typically launch a fund. He literally followed that pattern very strategically. But what we found was there were a lot of people who were coming to us who were not accredited that wanted to do a joint venture. For bandwidth purposes, we just did not have the bandwidth. So looking into, and what we decided to do was go the Regulation A+ offering route. Okay. So we, filed with the SEC and were able to get qualified to basically sell. It's essentially a fund to both accredited, non-accredited investors and market it publicly. And so it was really the catalyst of like, there's an opportunity to, and I don't love this phrase, but I'm going to say it anyways because a lot of people understand it. And I'm sure you know what I'm going to say, democratize alternative investing and make it accessible to people who might have IRAs with $10,000 or, someone who's not accredited but wants to look into other ways of investing outside of the stock market. So really, again, and obviously there are caps put in place by the SEC on how much those people can invest, but still it gives them that gateway to explore and experience alternative ways of investing. And so we've had and seen, we were qualified in July of 2022, and this will be our 2nd year. So we just extended our offering, and we've had a lot of success with people who, again, we're just in that category of, I want to try, this is my first alternative investment. We've seen a lot of people with IRAs come to us. I know we work with some of your guys' clients. So yeah, that was kind of the reason for going the Reg A route. And then my experience in business development and Chris's experience on the acquisition side really just like complemented each other well.
Fantastic. So with regard to how you actually structure this, and this is just my financial nerdiness coming out. So when you're actually packaging this together, are you doing it as like a pooled investment fund? Is it open-ended, evergreen? Do you have a cap, or do you segment these things into different funds? At least on the technical side, how exactly are you putting together your Reg A?
Yeah, so our Reg A, all Reg A's have a max raise per year of $75 million. It'll be evergreen in the sense that, we'll continue to raise capital. There is a 4-year lockup. At the end of 4 years, you can continue to leave your funds there. It doesn't, re-up for another 4 years. But at that point, essentially, you're at will is what I call it. You can exit the fund at any time and redeem for your initial investment. It is strictly an income play. So something that we saw with COVID, and even now more so, is a lot of people, growth investments are great. I definitely believe in them. I think there's a time and place for them. And I think the younger generation this is something that they adhere to. It's like income. How can I subsidize my cost of living by investing in something that provides income, whether that's paying off something as small as my coffee or as big as a daycare or a mortgage payment, whatever that might be.
Yeah.
So really it is an income play. People are able to invest as little as $5,000 and receive monthly dividends into their checking account or to their IRA account, whatever avenue they choose to invest with.
Yeah, if my income can support my Diet Coke habit, then we'll be fine.
Oh, speaking my language.
So are these, at least for the structurally, is it just paid out on like a basis? Is it paid out on an underlying value of your basis in the investment, or is it some type of like pref that's paid out with a certain cap to a return on your capital or is it basically just kind of 4-year lockup investment pref? Like, give us a little bit of an idea of how that works.
Yeah. So it's a 4-year lockup, minimum investment $5,000, like I mentioned. Now the return is 8% annually, paid in monthly dividends. Now, we do have the opportunity starting at a $25,000 investment to offer bonus shares. So what that essentially means, because you're essentially investing in a private company and getting shares, all our shares are valued at $10, and that is a static price. It doesn't fluctuate like the stock market, which I feel like I need to explain because I get that question a lot. But say you were to invest $25,000, we would give you an additional 100 bonus shares, which is the equivalent of an additional $1,000 that you would both accrue 8% on annually. So it would bump up your return slightly. And then at the end of the 4 years, you would actually be able to redeem the cash value of those bonus shares.
Okay.
So your total IRR over the 4 years with the bonus shares, even though annually you're getting 8%, because of the kicker at the end, you're getting 9.14. So, and that there's different tiers all the way up to, 250,000, you get, 17,500 additional dollars.
Okay, cool. Yeah, I just always like that, especially when I deal with people that have Reg A offerings, since they do allow for not accredited investors. Just kind of give a little bit more of the nuts and bolts on the front end, because most of the people that listen to this or come to us and want more information, if they are accredited, they understand that a little bit better. But especially if someone's like, oh, I can't do this because I'm not accredited, and they hear, oh, I can be non-accredited and do it, I like to make sure I give a little bit more of the technicalities on the front end of what it looks like to invest in some type of private investment. So we can kind of move on from there. But again, I always like to make sure we kind of covered that.
Definitely.
So let's get into the actual back end of the investing. I know in our preface to this conversation, when we had spoke that you kind of, again, have the general, investment ideal of not always necessarily buying, just, nice polished performing notes. Obviously, those cost more. You do have the aspect. And again, if this is a kind of blend of buying, large tapes with some performing, some non-performing, or if you only focus on the non-performing for the repositioning, go into kind of, how you run this. We've covered, the fact that, this is an offering, and it's, an offering of a pooled investment fund that buys mortgage notes. So what are those notes? What goes into the back end of making this investment product?
Yeah, at a high level, our buy box is first position performing and non-performing notes secured by single family homes. So we're not looking at commercial, really maybe 1 to 4 units, but typically it's 1 unit. Now, outside of that, as far as like how we balance the portfolio, when you start out, and as with most funds, or I would think would be beneficial to do, a majority of our portfolio at this time is performing for purposes of cash flow, wanting to cover distributions. Now, as we scale, that will tilt. So right now we're at about 70-30, 70% performing, 30% non-performing. The more we scale, the more that will flip, because the bigger returns are going to come with flipping those non-performing. So when we are acquiring tapes of assets or one-off assets, it's really about the return that we can get right now. We're not necessarily saying we're only going to look at non-performing. It's really about states, lien status, value of the home, of the property it's secured by. Obviously, there has to be equity. That is a big buy box check mark that we have to, check, because you want to be able to have that coverage if something does go wrong. You want to be able to say, like, I'm going to get a full payoff should this go all the way to foreclosure. So again, it's really, we've probably have about 10 plus different, specific relationships outside of the, with brokers and whole loan traders outside of the, bigger sales that go kind of to anyone. And we're utilizing those relationships to see what comes to market and if it fits our initial buy box, and then we'll bid on it. So I don't think we're necessarily saying, okay, we need to be at, this percentage performing by this date or non-performing by this date. It's kind of a mix of making sure that we have that cash flow coming in while we're building and scaling. And also, the market is still adjusting from COVID. This specific market, mortgage note market, secondary market, as far as purchase price goes, because during COVID, values just went through the roof. So as you can imagine, if a value of a property goes through the roof, someone's going to want more for that note because there's more coverage for you, especially if you go take back the property. Mm-hmm. So for a while, what was interesting is during COVID, a lot of people and myself were like, oh, what's going to happen? The government has shut down your ability to do anything. And now it's expensive to purchase. So let's see how this plays out. But what in fact we found was, yes, pricing went up and was more competitive. Things that used to go for, just to give an example, say 60 cents on the dollar, we're going for 85, which is drastic for a non-performing note. Oh, yeah. But we were seeing record payoffs and refinances because rates were so low. People were getting government assistance and money. So, and people just going reperforming again. So that was pretty interesting there. And why that's important is because, again, right now as we're evaluating what we're buying, it really is based off of what is the return we're going to get off of this asset based on what we can acquire it for.
Sure. So on the acquisition side, what's kind of the average origination and seasoning of these notes? So these things, obviously, for something to be, considered not performing, you don't originate a note and 6 months later it's not performing. No. Most people don't want to touch that anyway because they never get any payments. So are these things that are originating, during COVID, or these these had 10-year seasoning? What kind of seasoning spread are you normally seeing on what you actually go out and buy, or is it kind of just a very large spread on that side?
Yeah. So typically we don't look at anything that was originated during COVID. Obvious reasons, the interest rate was ridiculously low. Values were way overinflated, still are in some areas. So most of the things we're looking at were originated prior to 2016.
Okay. Prior to 2016. Now, when it comes to the repositioning, I'd imagine, and I'm just kind of thinking out loud, correct me if I'm wrong, but the increase, the precipitous increase in interest rates, just like home values going up and to the right, same thing kind of happening with interest rates. From the repositioning aspect of it, is that good for your business that interest rates go up? Because if you're doing a loan modification or something, you're going to be able to capture that increased interest rate. So if you bought something for pennies on the dollar, the rate of return on that note just coming current at, let's say, 2.5 APR versus something coming current at 7% is significantly better for you. Does that play in, is that good for you, bad for you? Is it agnostic? How does that kind of play into your investment strategy?
Yeah, the word I was literally going to use was interest rate agnostic. Because when we're bidding on something, we are not bidding based off of, our bid takes into account the interest rate. Okay. So it doesn't really matter what the interest rate is. We are going to bid accordingly. Obviously, we'll have to bid a steeper discount if it's originated at 3% versus, say 6%. But so I'd say we're pretty interest rate agnostic. We don't necessarily alter the interest rate or modify the interest rate of the current loan. It's more about, I'll give you an ideal kind of, not ideal, a example of something that's pretty common. And I think a misconception in the industry. People don't necessarily just wake up one day and say, I'm not going to pay my mortgage. Today's the day, no thank you, Chase Bank. What typically happens is what we saw during COVID, job loss, health, divorce, death, something, some life change that causes them to stop paying their mortgage. Now, then what happens is when they're able to start making their mortgage payment again, they're so far behind in late fees and arrears. So many arrears have, been tacked on. And a traditional bank like Chase is going to say, well, yeah, you can pay us, but we're going to apply all those to your late fees and everything before we, bring you current. For someone who's 30K behind, that just it's like that snowball effect. It's kind of like a screw it, what's the point? I'm never going to get caught up. I'm paying fees on top of fees on top of fees. But they can still pay their monthly payment. So when we come to them, we're able to work with them. For example, we had someone where They were behind, I think it was like 8 months. We were able to collect both they were started paying their monthly P&I again, and then they were making quarterly payments to get caught up. So we just have a little bit more flexibility than the bank. So not only are we getting them reperforming because they're paying and we're able to season that for 6 months to sell it as performing, but also we're collecting those payments, we're collecting the arrears. So there's so much more to it than just the interest rate is kind of what I'm saying.
Oh, no, I definitely get you. And from that point, you're talking about current interest rates, as compared to what the originated interest rate is.
Correct.
Okay, gotcha. Now, again, well, I guess it brought up an interesting point and of what you said of how that necessarily works. So on the acquisition side of what your fund is doing, are you necessarily buying just like tranches from like the banks, or I would imagine that they're not selling as many with the inflated property values. I'd rather foreclose it and be able to capture on the property sale side. Or are you kind of going more of the individual route to people that have issues with performance? Where does the acquisition on this stuff comes, or does it change depending on the market?
Yeah, great question. So typically we're buying from other funds who may not do performing or may only do seconds. We're buying from whole loan traders who have relationships with credit unions and banks or hedge funds. The interesting thing that I think is a little bit different than you might think is banks are actually, let's take Silicon Valley Bank, for example. They had two options. We can mark to market our loans and sell them at a discount, at a loss, but then we're able to re-originate paper at 6%.
Mm-hmm.
Or we can do the whole management and foreclosure, and exactly what you said. The values are great. So the thing about banks is they're really good at creating debt. They're very bad at managing it, as we're obviously seeing in today's environment. So for them, it's a quicker win to sell at a discount, sell tranches to, you have your huge funds that are, taking down thousands of tapes. And then it kind of drips down to other smaller funds such as ourselves.
Yeah, and also, at least from my professional experience, coming out into the alternative asset space of what I did, banks are really bad at selling real estate. Cutting my teeth, coming into finally getting into a position where I was, handling client money and actual directed investments. I can't tell you how long I spent just wanting to throw my phone at the wall. I probably threw a few handsets, to be honest. The management's listening, but just trying to deal with people like, I'm going to pick on Bank of America because they're the ones that I had the worst experience with, but just trying to get them to offload these REOs was impossible. You would get contracts kicked back for one required addendum for the state to comply with let's say the Florida bar, and it would be a 6-month process. I had clients that were 9 months into trying to buy one piece of real estate that was sitting vacant that these people owned. So I would hope that these banks learn just how labor intensive it is to sell real estate, which I think might lead into the fact that they're still selling these mortgages and not necessarily wanting to foreclose them as much. But that's one thing I learned, that is banks there are many things is that they're good at originating, that they're really bad at selling real estate.
Yeah.
So maybe they learned, who knows? But as we see some of the issues that keep popping up, maybe they didn't.
No.
Maybe there's some management turnover that didn't learn that lesson. So we kind of covered, again, how the acquisition side works. So just to kind of recap, you're buying these from other funds, maybe they had something that was performing, now it's not, and that gives an opportunity for you. Relationship building obviously is key in any business, but, things like credit unions, other banks, you have, again, it's always bad to kind of look at, with anything bad happening, there's always opportunity, things like having it like SVB, obviously that opens up their whole book of business to get liquidated, and then people come in and pick it apart. Opportunities for people like you. But as with anything in the investment world, this isn't just kind of a perpetual cycle. There is, an exit strategy to all this. As much as awesome it would be for y'all to just continually to acquire assets, is there an exit strategy for this portfolio? What happens when these things, maybe pay off or refinance? Are you seeing an increase in that as property values rise, people are able to just sell? Are there any kind of issues that are causing that? Again, Roblox, you want to own mortgages. You don't necessarily just want to have big blocks of cash. So if people are selling these, what kind of challenges are faced in that, and what does the exit strategy look like for some of this stuff?
Yeah, so our exit strategy is kind of like, and I think we talked about this a little bit, but in our call prior to the recording is really to fix and flip mortgage notes. So our goal is to get them reperforming, being able to then season them and get them labeled as performing, which is not like a process. It's just kind of you have to get consistent payment history to call them or sell them as a performing note. And so we're buying them, say, at 60% of value, and we're selling that, increasing the value by getting them performing and selling them for 80, 85, 90%. So that's kind of our exit strategy with most of them. I mean, some of them, yes, they do go to foreclosure, and we typically are not in the habit of taking back properties. That is not our business model. So if we do have that happen for whatever reason, we typically liquidate that asset.
Okay, gotcha. Now, so basically what you're saying, right, is that your whole, again, business model is mainly focused on getting that, deep discount, being able to get it reperforming, collecting those payments, and then selling it off at a higher spread. If you bought it for 60 cents,
Yep.
valued $1, and you sell it, reposition it for 80 to 90, that's kind of, again, the general play, if you will, on your investing strategy for this, correct?
Correct.
Okay,
Yep.
and are you trying, and I talked with someone else, and again, I always like to tell people, if I get too far into a secret sauce of whatever you're doing, feel free to stop me, but I like to ask these questions. So I talked with one company that basically was in a similar situation to you. They bought non-performing, repackaged it, but they also had a separate fund where basically they would take it, repackage it, and then sell it into their other fund for a performing note portfolio that had a whole different, structure and everything. Are you basically just in the market for the non-performings and then sell these externally, or do you do something kind of similar?
We don't have like a separate kind of fund that we feed into our performing only. It is a mix. We've had performing only funds in the past, but because of the type of fund that this is, being the Reg A, it doesn't really make sense from a like cost or bandwidth perspective.
Okay, gotcha. So from the perspective of, again, getting into it now, obviously with changing markets brings issues that people don't really necessarily see. Again, the whole aspect of the values being so inflated causes your discount per dollar to be potentially smaller. Now, what kind of issues have y'all faced in that changing marketplace of rising interest rates, doing things, or is it just kind of, again, do you just organically take the same model and it just scales up, just different price points, but the returns also increase, so things just kind of typically work out? Maybe let's kind of breach into some of the issues that you see in your market, because obviously not everything is perfect in any world.
Yeah, no, I mean, I think the biggest things, are inventory, which until about Q2 was significantly less than we had seen prior to COVID. So for example, say we saw 300 million across our desk in Q1, and Q2 we saw that in the first few weeks.
Oh, wow.
So, I think this last week we saw $1 billion come across our desk, which is astronomically different than 6 months ago. So inventory is there, which, supply demand is simple concept. Our pricing is starting to soften on those assets, which is great. What I think will be interesting is come, September, October, when all of the government programs end and people are starting to have to make payments again to student loans, government funding for excess childcare, all of that. When that all ends, it's going to be interesting to see the defaults happen, because I don't think people have been planning or well prepared for that ending. And I think we're going to see record defaults in probably Q1 of next year.
Yeah, I think you're not necessarily too far off. Especially when it comes to the student loan repayment, kicking back in, because that can be very significant, especially for people who, and this isn't kind of an examination of anything other than just the cold hard facts of people not having a payment and making certain financial decisions, then having that come back into effect. Again, what's it gonna look like for everything like that? Now, again, going forward into the future, you said you weren't, obviously the purchasing side of things, you're looking at, maybe 16, 17, 18, 19, as far as kind of, the origination date of the mortgages that are, coming in. But eventually, you're going to have to probably start to look at stuff that was originated during COVID. Is that something that you're just trying to, what do you think is necessarily going to happen when those mortgages are the ones that are going to start coming around on the secondary market? Do you think that, and again, this is just kind of thinking off into the future.
Yeah.
Do you think that pricing is going to have stabilized enough, or is it going to be pegged at a point to where, okay, this is, again, what we think right now is, again, kind of an aberrant market of pricing. Do you think it's going to stabilize at this point? Kind of, again, just thinking out loud, where do you think this is going to go in the future, and what does that mean for your firm?
Yeah, I think that pricing is going to stabilize and be more favorable for us in the coming years. I also think that something I've seen specific to this asset class is before you had people like me who could get in, build their own portfolio, because the pricing was like so good. I think it's kind of knocked a lot of people out of this asset class for the past maybe year and a half.
Yeah.
Who wanted to get started and kind of had read all the books that tell you how easy it is, and then realized like, oh, the pricing isn't what it used to be. Even me, when I first started doing this, worked with someone who has been doing this since like the 90s. The prices he saw were astronomically, they were crazy. They were amazing. And so I think it's just kind of getting rid of, or kind of like closing the doors to people who want to start out in this asset class. And so what we're seeing is they may not be able to get in from non-performing. So they're either investing in a fund, ours or another note fund, because they like the asset class, or they will buy performing because there is a market of investors who do want to not have to deal with non-performing. They just want mailbox money. And while it's not 100% mailbox money, because it does always have the chance of going non-performing, it's easy to sell those performing. So I think there's a market for performing for us to sell to, which is great. And I think that will continue to get bigger as people can't break into this industry or this asset class. And yeah, that's kind of just thoughts and things I've seen.
And I think you really kind of hit on the point too. And I think it kind of goes into the psychology of the marketplace a touch with just how expensive everything has gotten. Gone are the days of seeing, wild discounts on anything. I mean, whether that's, going to Walmart or going to buy real estate, price inflation and price point, fixation is really kind of settled into the market. What we thought was going to be something that maybe faded out in 2001, didn't fade out in 2022. And now we're in the middle of, it is August 18th, which is wild to think about anyway. But, we haven't really seen this softening or the spread of the discount rate on anything, whether we're talking about the Fed discount rate or we're talking about just discount rates on anything. So again, making that attractive, making the purchase of a performing asset more attractive, whereas, people that really wanted that discount, are, it's like, okay, well, non-performing has its own risk and its own work that has to go into it versus buying performing. Again, I think it's, definitely going to be something to look at. But again, I think with that aspect, people looking at the performing stuff, that's going to take less eyes off the non-performing stuff and will probably help this market anyway. So, again, the changing trends, who's to say what's going to happen when, and no one has a crystal ball, but we would like to think that things are always going to help the market that we're in. So, again, I think that that's really interesting. And I'm a big fan of debt for a lot of people just because, real estate's many things, but not work intensive. It is not. Dealing with, again, tenants, toilets, having to repaint something is, I live in Florida. It's beautiful. Well, it's hot and steamy right now. It's very hot and very steamy right now. We got hurricanes. There's like 3 that might pop up in the next week or 2 that are coming around.
I know. I heard about this.
And you'll have a hurricane coming towards you in California right now.
I heard about that actually maybe a few hours ago as well.
Hurricane Hillary. So
yes, Hurricane Hillary.
Just don't buy into too much of the hype. Get some bottled water. You'll be fine. But yeah, it's dealing with that is crazy, and I like to really kind of I can't advise people on what to do, but debt is a really attractive option, especially for retirement plan investors, because you have reduced amounts of liability. You have, if you're just talking about work in general as a point, it is less work for you to deal with a mortgage note in general than it is to deal with a property, and especially you can get into them for lower price points, whether that is someone needing additional funding for a project, dealing with a fund like yours. It's going to make things a little bit simpler from that aspect. So I really enjoyed that, and I like having people on here that can talk to that good alternative to just buying real estate, because so much of our AUM here is real estate direct ownership, and getting into something like what you offer, especially for being a Reg A fund, for being able to accept in lower price point, not accredited people, IRAs and non-IRAs alike, is a good for people to understand. So, with that, we're kind of hitting up on our 45 mark minute that my producer likes to make sure that I stick to. I could talk to investors for hours, and she knows it. So any kind of closing thoughts on, some salient points that maybe we didn't hit on that you think would be good for people to understand about what you do, why non-performing is good, anything else about what you have going on? Obviously, make sure you give your contact information, how people can find you as well. But what else would you like to end on?
Oh man, I feel like we covered pretty much everything as far as mortgage notes. I will say that the one thing I find, and I don't think this is true specific only to mortgage notes, I think this is in general, is that there's a lot of hype out there. You see a ton online about people who, make it sound super easy that anyone can, buy a multifamily property and retire tomorrow. I think that maybe there needs to just keeping expectations real with in alignment with where the economy is. 5 years ago, you could put your money probably in any real estate asset and it would have boomed. You would have made out like you did. Yeah. Yeah. You quit your job immediately. But now I think it's really asking yourself when you're looking at an investment, whether it's your own investment or you're investing in a fund, like, does this company take on additional leverage? Am I too over leveraged if it's an additional, like a personal investment? Making sure you have the resources if it's, you're buying a rental home, or making sure that you're comfortable if you're investing in a fund with the amount of leverage, if any, that company is taking. So I think that moving into the next few years, that's probably the one thing I would, as an individual investor myself, be cognizant of, because I think a lot of people are going to get caught in sticky situations, and I wouldn't want to be one of them.
Yeah, absolutely. I encourage people to do your homework, understand what you're getting into, whether that's investing into, a secondary mortgage that you went out and found, whether that's investing into a firm like 70s. Do your homework and just understand, the inherent risk with anything that you do. Mailbox money is a really fun term to put out there, but understand what kind of comes into that. Do your research. You don't want to be taking an expensive, course with your retirement fund or something. Do your research. There's deals to be had. There's money to be made. But make sure you put in the work to understand what you're doing. So if people want to get more information from you, Lauren, or want to potentially invest with you, what's the best way to get in touch with you? Website, contact information. Give us the best way to reach out.
Yeah, so our website is 7E investments.com. That would be the best place to go to kind of learn a little bit more about who we are, what we do. And then if you want to reach out to me, I always offer my personal email directly, because I remember what it was like when I wanted to speak to people and pick their brains, so I always want to leave that invitation open. You can reach me at Lauren, Lauren, at 7einvestments.com, and I'd be happy to answer any questions you might have, whether it's about our fund or mortgage notes or just investing in general.
All righty. Well, thank you very much, Lauren. This has been another edition of the Alternative Investing Advantage podcast. My name is Alex Perney. As always, thank you and have a great day.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.